Welcome to the RobatDesk podcast. I'm Rob Blasi. Today, I'm with the prolific investor, Chris Odegard. Chris, how did you become the prolific investor, and how do you get it? Like, how do I get a prolific title?
Well, mine's a self-proclaimed title, so I just started calling myself that, and it actually stuck.
Oh, all right. So I'm the prolific. I would say prolific podcaster, but I'm not.
Yeah,
So,
you fake it till you make it. You grab the title, go out there and tell everybody, and you say it often enough, long enough, and people will believe you. Hopefully, you have a track record and some history that would support that. Some social proof, et cetera, et cetera. So
yeah, I'll just throw expert in front of stuff because no one really. How do you verify expert?
Yeah, exactly.
So yeah, but prolific investor. How did you become a prolific investor?
Well, I'll tell you the story. So, like probably a lot of your listeners, I was a conventional investor for most of my life, and that means that I invested for my future and retirement and financial independence with mutual funds through a 401k.
Okay.
What I now refer to as the 401k highway to mediocrity.
Okay.
And the 401k is the primary investment tool for retirement. Doesn't work for 92% of the population. We can talk about that later. So that's kind of a startling statistic. That means like 92% of the people are going, shit, that doesn't work for me, right?
Well, where do you, like 92%? Like, I'm always going to ask, like, where'd you get that number? Like, how do you define not work?
So so first of all, conventional investments are everything that's publicly traded: stocks, bonds, mutual funds, ETFs. Everything else is an alternative. So real estate, ATM machines, business equipment, private shares of small businesses, commodities, and so those are alternatives. So most people are putting their money into a 401k.
Okay.
And when conventional investors talk amongst themselves, or when they talk with advisors, one of the questions is, how big does this 401k mountain of stuff need to be for me to retire?
Mm-hmm.
And I think that's really the wrong question, because the real question is, well, how much income do you want to have in retirement?
Yeah.
So the conventional investment consists of these conventional wisdom, consists of the conventional type investments. And then another thing is something called the 4% rule.
Okay.
And the 4% rule is the kind of the rule of thumb that financial advisors give to investors. And they say, look, you can withdraw 4% of your portfolio every year to generate the cash flow to live on, and you're most likely not going to run out of money before you run out of life.
Okay.
So, because conventional investments don't produce cash flow, you have this mountain of assets, and then the only way you can live off of them is you have to sell off a chunk of it every month or whatever to generate kind of a paycheck to live on.
Yep.
So if you ask somebody, how much money do they want to have to live on in retirement, and they said $100,000 a year, you go, okay, you would take that $100,000, divide by 4%, the 4% rule, and that would tell you that you need a 401k portfolio of $2.5 million.
Okay.
And so most people probably don't have, and I'll get to this 92% in a minute, a lot of people aren't going to get to a $2.5 million portfolio. So you could say, well, maybe we set our sights too high. $100,000 a year, that's a lot of money to live on.
My house will be paid off when I'm retired.
You don't need that much money. So let's go down to the median income, which is around $63,000 a year. And then let's do that calculation again with the 4% rule, and you still come up with $1.575 million.
And you're talking about like what I would call like investment assets. Like my house wouldn't count towards that 1.5 million.
No.
I'm
just talking about your investment. So whether that be the stocks, bonds, and mutual funds in your 401k, outside your 401k, so that portfolio in total would have to be that big. Yep. And you say, okay, well, how many? So in both of these situations, you needed either a $2.5 million portfolio or a $1.5 million portfolio. So that means these retirees are millionaires. Mm-hmm. So then you say, well, what percentage of the population ever achieves that status of having $1 million of net worth? And the answer is 8%.
Okay, so that's the 92% failure rate. Yeah. And why do you think? So here's why do you think people don't get to are only getting 8% are getting there to like the $1.5 or $2.5 million? Is it?
Well, it's price. It's precisely because there's a lack of financial education, and people are investing their money into 401ks, and 401ks are a terrible investment vehicle. But that's what everybody comes out of the womb going, get a job, get a with a a 401k and benefits, and sock your money in there, and then later you'll be set.
Well, I think part of it is people like. I slightly disagree. It's like the Dave Ramsey disagree. Like I agree with you in principle. Like it's the 80-20 rules. Like 80%, yeah, but 20%. Because I also believe on that 8% or that 92% failure rate, and you're gonna disagree with me too. Who knows? I might be prolifically wrong. So
well, go for it. Hold on to those. Do it strongly. Whatever.
So, Chris, I'm gonna say with confidence is that also people aren't putting enough weight into those plans or in those tools. I'll just say investment tools. Like you can agree or disagree how good a 401k is with the fees and things like that, whether you're putting it in your own E-Trade account, Charles Schwab account, whatever it is. But I think more people are just putting well, my company gives me a 3% match, which is great if you can get it. And so they only put 3% in, which is maybe they should be putting 10% away. And so people aren't realizing, especially it's one of my biggest regrets is I'm in my early 40s now. I wish I realized, I knew it, but I didn't practice it. It's kind of like getting in shape. You know what you should be doing, but you know what? You still go to the drive-through a few more times than you should because it's just easy.
Right.
I think people are, they only put their 3% plus match away when they should be putting 10, 12, maybe even 15% away, especially in their early years.
Right.
Where that money can compound to multiple times.
No, that's so there's I did what I think was a really great article on this.
Okay.
And I'm just kind of pulling it up here real quick.
I have some personal examples. I know people that have great income in the sense they have great jobs. They have important letters in front of their names. Right. And they have great income. But then I still remember in conversations were oh yeah, we're only putting 1 or 2% away because we want to be able to have the money now for stuff. And you're just and they're saying this in their late 20s, and now we're all in our 40s, and you're going,
right, yeah.
They're gonna fall in that 92% gap. And I just how many people are deferring for later gratification?
Yeah, well, certainly. So there's a handful of things that, well, let's say there's 4. This is from one of my recent articles. There's 4 kind of wealth building principles.
Yeah.
And I made these up. I didn't talk with anybody, but I think that some educated people would agree with this. It's not that hard.
Okay.
So number 1 is how much do you invest? So the amount of money that you invest is a key. Yeah. And keep in mind that the only money people have to invest is the money that's above and beyond their living expenses. So if you make $50,000 a year and your living expenses are $50,000 a year, you make 0, right? So you only have that money that's above. So the amount of money that you invest is key. The return that you get on that money is also key. The amount of taxes you pay on the earnings, and then the velocity. How quickly does your money, flow in and out of into investments, and is not sitting idly doing nothing for you in a savings account earning less for 1%. So those are the 4 kind of overarching things. But you hit on the very first one. Sometimes people aren't investing enough. Well, that's true. But let's talk about the returns. So, the S&P 500 over the history of its existence has returned on average about 9.8% a year. But studies have been done. And if you look at the environment now that we're in, inflation is almost that much right now. Right. So if you say, well, I'm going to get an average of 9.8% before taxes inflation within this inflationary period that we're in, you're not even maintaining your borrowing power, right?
Yeah.
But studies have been done about how much the average stock investor makes, and they only make around I'm looking here at my notes, 5.19% because of the way they get into the market, the way they get out. They start investing, they stop investing. So if you're trying to get, to that mountain of money with an average annual return of 5-something%, you're not even maintaining your buying power.
Yeah, no, especially what I've learned with some friends here that, we play around with some stuff. You have that play account where you're, buying stuff on like, I've learned that the more I just leave it alone, the better it does.
Yeah. Right. Yeah.
Is that because people they think they're going to buy at the high. It's like, those are just too many algorithms and computers out there doing that for the smart people.
Right. Right.
And you're trying to compete. It's like playing chess against a computer that's an advanced player. It's really hard to beat that.
Yeah. Right.
So then so it's like you've raised all these problems, like you can't do it, this is bad, you're gonna fall in 92%. How do we land in that 8%? What's your answer for that?
Well, my answer is alternative investments, which, like I said, is everything other than the conventional investment.
Yeah.
So let me give you a reason why I feel comfortable putting prolific, behind my name. Not because I actually want to put an acronym behind my name on my business card. That's NAD. It stands for no advanced degrees, because I don't have any advanced degrees. But so I was just running along being a conventional investor, because that's all I knew until about my mid 40s. And
was that your career, like in investing in finance?
Oh, no, I'm an airplane guy. So I started off as an airplane mechanic, and then I worked at Kennedy Space Center, and then I worked at Boeing out in Seattle. And so I had
is that Seattle behind you there?
That's Hong Kong, one of my favorite cities.
Oh, okay.
But yeah.
Okay.
So yeah, I was kind of a normal, if you've ever read Robert Kiyosaki's book, The Cash Flow Quadrant, I was an E. I was an employee. And that's what I did. And then in my mid 40s, after having been a conventional investor for, decades, I had this illiquidity event where I lost 55% of my assets and thousands of dollars
Can I guess?
a month.
Can I guess?
You can guess. Go.
I guess was it somewhere around 07 to 08, maybe a hint of 09?
It was actually 09, but it was not because of what you think it was. I got divorced.
Oh,
and that's what that on top of all the normal losses, I took this big hit. And around the same time, a friend of mine said, "Hey, you should read this book." And the book was Robert Kiyosaki's Rich Dad, Poor Dad. And that book opened up this whole world of alternative investments and things outside the 401k that I never knew about. So I started moving in that direction very quickly with some rental properties, and then it moved on to apartment buildings and self-storage and ATM machines and all kinds.
What's your favorite one of that group? I have my favorite. What's yours?
Multifamily apartment buildings, my favorite.
Really?
Yeah.
Now, do you buy it to the point where then you're also like having to be the manager, or you just buying like a percentage of it?
I invest in syndications, which are limited partnerships where somebody else is doing all the work and all I have to do is wire in the money. And I get all the benefit. I get the pass through depreciation. I get the tax benefits. I get the returns. I get all the benefits without really having. And most of these properties I've never seen and never will see. I'll give you an example. So I invested in an apartment building in Atlanta 40 months ago.
Mm-hmm.
It was a $40,000 investment, and that apartment building sold about a week or so ago, and the total cash back to me was $75,000. That's a 25%. It's a 27% average. It's around a 27% average annual return.
Wow.
And I didn't pay any taxes on that money either because of depreciation. So that's how when I talk about the four things: how much money you invest, how much you make. So making a 27% average annual return and almost doubling my money in a little more than 4 years and paying zero taxes on that money. That's how you get there. Much faster.
So, my wife and I debate about like when you put the money in the 401ks, the pre-tax or post-tax account, which one's better. Yeah. All that. Like we have a mixture of both. I think it's one of those like let's hedge our bets a little on either side.
Right. Yeah.
But no.
So I mean,
that's huge.
Yeah, and so after I lost 55% in 2009, in 9 short years, I had made all that up and multiplied it many times over and quit my job and never have to work again if I don't want to. And I wouldn't have been able to do that if I had stayed on the 401k highway to mediocrity. So I started.
First off, congratulations.
Thank you. and I kind of left the company earlier than I had planned at 56. Now that's not I wouldn't call that a necessarily great accomplishment, but I think it's quite an accomplishment when I had just lost 55% of everything 9 years earlier.
Oh yeah.
So that's when I started my blog at theprolificinvestor.net to share what I know and what I've learned, and then and wrote the book also last year. So.
And what's the title? Is the title of the book Prolific Investor?
No, the title of the book is "Get Off Your Ass and Manage Your Money: Why You Need Alternative Investments."
Oh.
And it looks like that.
Oh,
so
nice.
Anyway, there you go.
And they can find that at Amazon and your site. And
yeah. If you go to my website at theprolificinvestor.net, there's a flashing green star. You can't miss it. It says the book's available. And if you go to Amazon, the best way to do it is just type my name in, Chris Odegard. It'll come to the top quicker than if you put in the title. Yeah.
Okay. So that's interesting. So you're doing how do you get involved in investing like this? Because it seems like it's more like you said, you're getting involved in smaller companies that aren't publicly traded. So it feels like you need to know someone to get connected with these.
Well, you definitely have to immerse yourself in a different environment. So you have to get educated on this kind of stuff. And the way I did it was with books and podcasts, and then joining some, networking groups of these type investors and going to conferences, and pretty soon you start meeting people, and pretty soon you're kind of in the know of all these different opportunities that are available. You have to be smarter than in the stock market, because you can't just say, well, I'm going to put my money in this index fund and I'll forget it and it'll adjust over years. You are putting your money with a smaller group of people. And the nice thing about this is, if I invest in Coca-Cola, I'm never going to meet the CEO of Coca-Cola. But in these types of ventures, I do, get to meet the people and get to know them, and, make some assessments about their character, which is, very important. So yeah, you just gotta get educated, and it's actually a lot of fun. You meet a lot of interesting people, do some travel, attending conferences and learning things. And I'm on, biweekly and monthly video calls with investors, and we talk about, well, what are the latest apartment deals coming up? What's happening with the tax code? What can we do? So yeah, you gotta study.
No, I mean, yeah, nothing. If it was that easy, I think everyone would be like, oh yeah, why wouldn't you? Or there'd be some SPAC out there doing this.
Yeah. Well, it's no harder than getting a college degree, except it's a lot more profitable than what most people got out of their college degree, and actually less expensive.
So what would you say someone would need to sort of the starting available assets to be able to put into something? What would you like?
Well, it depends.
And by the way, what would you call the risk factor on something like this? Because a lot of people would do the 401k thing because they believe it's relatively safe.
Yeah. So you could do the 401k thing and get your average annual return of around that most. Let's say you actually get the S&P 500. You get a 9.8% average annual return before taxes, inflation. But I'm getting 20+% average annual return, and that doesn't include the tax and tax free. So I think
but what's the risk factor? Someone may get 9% into the average over 10 years, of the long term, but that money's safer in their mind. They sleep better at night knowing their money's in the 401k. But if I'm investing in a multifamily unit, am I liable if something goes wrong? What's, just like any ownership thing of a
right.
brick and mortar fixture, what's my liability? How much do I get to sleep at night?
Yeah. It depends on how you invest. If you go out and invest directly in rentals, whether it be single families or multifamilies, then yeah, you have some liability, but that's why you have to set up a company, an LLC, to shield yourself. So that's how you would have insurance on the building, just like you do on other things, but then you would set up some type of entities to shield you from getting into your personal assets. I understand what you're saying, but the way I invest in syndications, I'm a limited partner, and that limited means that I have no liability. The only thing I can lose is my investment. There's nothing from an apartment building that's going to reach in and grab my assets.
If someone slips and falls down the stairs at the apartment,
not my problem. Yeah, not my problem. It could burn to the ground. doesn't matter, right? So
Yeah.
that's what the general in a limited partnership you have a handful of general partners, and then you have a larger group of limited partners like me who are the ones that put up the money for the down payment. We have zero liability to anything that happens in that building. The
Okay.
worst that happens is it gets completely mismanaged and we lose. But it's hard to say, because in the stock market, things go to zero. Companies evaporate
Oh,
and
yeah.
go bankrupt. Buildings and land don't disappear. So at the end of the day, with a real asset, there is always something still there.
Yeah.
There's a structure, there's a piece of land underneath. So it's hard to lose everything, right?
I'm glad I didn't put everything in Peloton 6 months ago.
Is it gone? I don't know what's happening with Peloton.
Oh, it was brutal. I don't know, remember the exact numbers. I made a little bit on flipping it when they dropped from the recall a little bit.
Yeah. Yeah.
But then when they when their earnings numbers came out, I don't know, a couple months ago, they've tanked a little bit.
Well, you talk about risk and being able to sleep at night. I actually don't know how conventional investors and people with their money in the stock market do sleep, because their investment, every day they can watch the value of their investments go like this. I can't. I don't know what the value are. The apartment buildings going up and down in value, maybe, but it doesn't make any difference until it's time to sell them.
But then what's the out clause though too? Like, because I've never invested like this. So like I would say, like, say I throw money in my E-Trade account to go invest in Tesla and Microsoft, because I know those companies a little bit. They'll go up and down. Tesla's a great example of up and down.
Mm-hmm.
But I can pull my money out and go, because my hot water heater went out. I need the cash.
Yeah, right.
But like, so you invest in this apartment complex, and 40 months ago, where all of a sudden you go, oh, like, I need the cash. My car broke down, or
can't get it.
Can't get it.
It's completely illiquid. No. You are putting your these are not publicly traded things. They're privately traded. So you are putting your faith in the general partners and the people that they hire to run this business, this small business called a 250 unit apartment building.
Yep.
And you are in it until they've decided that it's time to refinance it. And I may get and this happens routinely, I may actually get all my money back and still own the building because we've done a cash out refi.
Okay.
But then at some point in time, they will say, this is the prime time to sell. We're going to sell. And that's when I'm really out of the deal. But I have no control over that. Yeah, I can't.
So I'm assuming it's building by building, but say a 250 apartment complex, you're a part of the purchase of it.
Yes.
And being a limited partner, like at the end of the year, and they're doing their dividends, if for better or worse terms of it, do you get dividends out of it annually as well if there's a profit in there? Or
it's not a dividend is something, I wouldn't call it a dividend. And it also depends on what the philosophy. So some of the investments are, we're going to buy these properties, apartment buildings that have been run down and mismanaged, and we're going to put money into them, improve them, and raise the rents. And then these aren't cash flow things. So I might not get any money until they're sold.
Okay.
3 or 4 years. And then there's other ones where it's a within the first quarter or so, it's a cash flow thing, and I'm getting a % of the profits every month. So it just depends on which way it's structured. Model. Yeah. One of them's kind of almost like we're flipping apartments over a 3 or 4 year period. The other one is, no, we're buying a cash flowing rental that's going to generate income from almost day one.
Yeah. Okay. So it's good to know then there's those options, and because I think that would be the concern as you go, well, I just put, like anything else, is you don't want all your eggs in one basket for stuff like this. Do you still, because my guess is you probably still have some money in a 401k like tool.
I do, really only because, I had put so much money in there, but I've been taking that out because frankly, the tax benefits are better outside the 401k than they are inside. Oh. So, in 20, and I think it was 20, I wrote an article on this one too. Let's see, what year was it? Go back. I think it was 2019. 2019, I paid, I paid zero income taxes. And I did a little bit of a joke about it because, Trump paid $750 in taxes and I paid zero,
So you're the one everyone's complaining about. Got it. Okay.
So anyway,
interesting. So I would say the downsides are it's not as liquidable because, like, once again, you're in a smaller group, and my guess you also have to, if you did need to get your money out, there's probably more restrictions on how you would get it out.
Yeah. So I've done, I created something called the hierarchy of investors, where I compare conventional investments against alternative investments over 13 different categories.
Mm-hmm.
And the only disadvantage to alternatives is just what you said. It's illiquid. You can't get your money. That's the only disadvantage.
Because I have a friend, because he, like, with COVID and everything, they had a little hit on their income, and like with the COVID rules, like they actually, you could pull it out your 401k money up, I forget, up to certain amounts,
right,
and relatively tax free. You just basically have to claim it as income. You don't pay the penalties.
Yeah.
So
well, but think about why do people, if I have an apartment building that's throwing off $500 a month in cash, but the one thing you don't have out of the stock market is you don't have cash flow. That's the reason people need liquidity, is because there's no cash flow coming off their investments. If you have alternatives that are generating cash every month, you're less likely to actually need liquidity, right? Because you've always got a source of cash coming in, and hopefully it's cash that's above and beyond, kind of your living expenses.
Oh yeah, no, it's like anything else. Is like there's the plus and minus of it. I'm thinking out loud here. Because, like, I mean, like in the stock market, you have good dividend payers, which you could argue is like if you wanted to be your cash flow. Yeah. But most of those, like on a good one, you're looking at 4 or 5%. Like I think Verizon's around in that mid 4s.
Right. Yeah.
And there's some other ones, like the midstream ones always scare me with how they can fluctuate those.
Yep.
But all right. So yeah, it's interesting. Some things to think about. That's for sure.
Well, we talked about the fact that how much money you could invest is important also. So if you're a young person, you say, hey, I'm going to go jumpstart my, and let's say you're investing outside the 401k, you're in your Schwab or Fidelity account, whatever your brokerage is of choice. And you say, okay, I'm going to jumpstart my investments. I'm going to start with $30,000. So you take your $30,000 and you walk down to the bank and say, hey, Mr. Banker, I would like to buy I want to buy $100,000 worth of mutual funds. I'm going to give you 30 as a down payment. I'd like you to loan me the other 70,000 on a 30-year fixed rate mortgage. Guess what?
Good luck.
It's interesting that banks, they don't feel that that's a good asset to loan against, but I can take my $30,000 and say, I want to jumpstart my investing. I'm going to go to the bank and I'm going to put $30,000 down on a $100,000 single family rental and get a 30-year fixed rate mortgage. And they'll do that all day long. And also I can insure that asset. I can't insure my $30,000, stock portfolio. But the bottom line is, on the conventional investments, with $30,000, you get $30,000 worth of stuff. With $30,000 in alternatives, you can get other people's money in the form of a loan to buy more stuff, and that gets you there quicker.
Yeah, but then also, because I see all these videos on like Facebook or all those where they're talking about invest in real estate, all this stuff. But like if there is another like 07, 08, it was detrimental to certain real estate markets too. And then, what about in the last couple of years with COVID, especially with the rent freeze?
Well, I've had real estate through that whole time, so I can tell you, I had some of my first rental properties that I bought, around the. I had a condominium in the Seattle area that I bought at the height of the market in 2007. And when the market crashed, that condo lost 50% of its value, but it was a rental and it was full. And I had renters all the time, and the rent continued to go up through that whole time. So half a dozen years later, the market recovered and the price recovered, and I sold it. So if you buy a solid piece of real estate that's cash flowing, the only time the price matters is when you're going to sell. I didn't need to sell, so I just wrote out that, and I had the same amount of cash flow. And the same thing happened all the way through COVID with ATM machines and apartment buildings, just solid cash flow all the way through there.
You can invest in ATM machines.
Yeah. Also, you could go out and buy ATM machines yourself, haul them around in your pickup truck and put them wherever. I invest in those the same way that I do in real estate through a syndication. So I own ATM machines all over the country, and I've never seen them, and they're all managed by somebody else, and I get what's called a blended return. Because if you had 6 ATM machines scattered out through some city in Ohio, let's say, every one of them, you would pull a different amount of cash off of that every month because of the number of transactions. Well, what we do is pool hundreds of these things together, and then every investor gets a fixed payment every month, and they have the ability to move these machines around if they're not performing. And they've done this for a while, so they know we can buy this many machines. It's going to bring in the revenue of this, and we know that we can pay everybody this amount every month, and we should be good. And so all that stuff, apartment buildings, self-storage, ATM machines, it all just kept on paying all the way through COVID. Not a blip now. And I don't know if the values went up or down, and I don't care. Right.
Now, the self-storage ones are always interesting to me because, like, I used to help sell steel buildings. And whenever you got someone on the phone that was interested in steel building, the people that were always the most interested, the people that own self-storage units. Like, I've been thinking about expanding. Those are the ones that those are the easy ones to talk to. A lot of other people are like, well, I don't know, but guys that own self-storage units, they were always looking to put up some more.
I read an article a few years ago, and it was about which types of real estate assets performed the best in a bad market. And number 1 was mobile home parks. Number 2 was self-storage. And I think number 3 were apartment buildings. So they're all very resilient to, bad economy. And the nice thing about something real like an apartment building is there's no technology on the horizon that's going to outdate people's need to go home and spend time with their family and sleep for before the next day's work. Now we see movies about that, people sleeping in pods, but I don't worry about, technology is doubling in about 18 months. I don't worry about what's going to happen with real estate in the next 18 to 36 months. People are still going to need that.
Oh yeah. No, that makes sense. So it's interesting. This makes me think, like, what would Coach Pete do?
There you go.
So, what would he say about this? I'll have to ask him. So, interesting. Well, you gave me some things to think about, Chris.
Good. Well, that's what I'm all about. There's just a whole other world of investing out there, and so the advantages are that it's the disadvantages is this stuff is illiquid.
Yeah.
But the advantages are, you get real diversification, because there's 4 major asset classes. Paper.
Yep.
So when you have a diversified portfolio of stocks, bonds, and mutual funds, these are all paper assets. Then there's real assets like real estate. There's commodities, and there's private equity, which is just private shares of small businesses. So of those 4, if you're in the stock market, you don't have any diversification at all because you're only in the paper asset class. So when you get outside of that and start adding, commodities and real estate, you get some real diversification. The returns are way higher. Like I say, there's hardly anything that I do that doesn't deliver between 20 and 30% returns.
Have you had one that's lost?
I did. I'll give you one, and I did an article on this one. It's not like I only put out the stuff that runs really well. I was buying, and this is a paper asset, a little bit of real estate. It's called a note. So if you have a mortgage on your house, that's a promissory note. Yeah. And sometimes the bank owns that note, and sometimes an investor like me owns that note. So I bought I think it was a non-performing note. That's where the borrower had stopped paying. It's kind of like rehabbing a house. Yeah. You buy this, a loan is an asset to whoever owns it, and it's a liability to the person that owns the money. So I had bought a non-performing note on a single family house in Indiana, and I think I paid like $30,000 for the note. And but
how much was left in the mortgage on that?
I'm just going to make up some numbers. Yeah. But let's say the mortgage would have been like I don't know. Let's say what would be a good?
Was it above $50,000?
Here it is, my worst investment ever. Let me just like I can put to it pretty quickly. So the note cost 24,000. The unpaid balance was 39,
Okay.
and the house was worth 53.
Okay.
And it was supposed to be owner occupied. The information I got on this, it was supposed to mean the owner wasn't paying, but they were still living there. That's meaning, okay, the place isn't vacant, it's
Yeah.
not a crack house. Well, by the time I got somebody out there to kind of do my own, take a look, it was not occupied, and it had been a crack house,
Oh,
and
geez.
it was a complete mess, and it was like in November, and I called some
What are your
contractors.
options then at that point?
Well, you could just write it off and say, okay, well that that $24,000 investment was a bust,
Mhm.
or I could go in and fix the house, and and then and
Because
then
do you
put,
take the title of the house at that point? Is that basically what you bought? Is it like is that the
well,
leverage?
it's I have the debt is secured by the house, which is I have the right to take the house if they stop paying, right?
Yeah.
Like foreclosing, and there's different legal instruments,
Yeah.
but so anyway, I got a hold of a contractor, and he went out and looked at the house, and he said you should donate to the fire department so they can burn it to the ground for
Oh,
practice, right?
jeez.
And I just wasn't ready to completely give up, so I got a couple other opinions. I got some people that said they could fix it, so I got it fixed, and I sold it with owner financing, meaning that they put something down, and then they start making me a mortgage payment, and then I turned around and sold it as a performing note. So after I've got somebody in there and they're paying for 6 months, now it's a performing note. So I took my what could have been a $24,000 loss, and I turned it into like half of that or something like that.
Yeah.
So anyway, it was all a class in lowering my reducing my loss amount. So that was one that
Yeah.
didn't go well. But I don't do those anymore. That experience and some other ones,
Oh, I could imagine.
I decided that that's not really. It was very labor intensive, not labor in terms of swinging a hammer, but man, it
Yeah,
was
but
just a lot of
logistics.
logistics, because I was living in Washington and the property was in Indiana, and trying to get reliable people to go out and do what they say they were going to do, and I just wasn't prepared for that, so I don't do that anymore.
Fair enough. Fair enough. Well, once again, if people want to get in contact with you, then go to your website, theprolificinvestor.net.
Yeah, and if you go there, there's a handful of ways that you can interact with me. There's a conventional wisdom quiz that you can take, and it'll, you answer these 10 questions, and it'll tell you what the right and wrong answers are. Of course, there's a link to the book. And there's a place on there for a virtual coffee. If anybody wants to schedule a 30-minute video conference with me and talk about this stuff, I set aside Thursdays on my calendar. So yeah, theprolificinvestor.net, all the blog articles, social media, videos, resources are all there.
Very good. No, you gave me some stuff to think about. So
good.
So maybe I'll talk to you on a future Thursday here.
Yeah, let's happy to do it. Happy to do it.
So, well, perfect, Chris. I appreciate the time. Anything else you want to before we part ways? Anything you want to? Do we miss anything?
Oh well, there's lots of stuff, but it's a big subject, and that's kind of why I wrote the book, because my path was kind of one step forward, 3 steps back, and I thought, if I were doing this all over, I could maybe lay out a more streamlined and economical and quicker straight line path. So that's a good place to start.
No, very good. So, and then I'll see what Coach Pete has to say about it, and we'll revisit this again. So, Chris, thank you so much.
Thanks for having me on. It was a lot of fun.
Glad to, Chris.